municipalities received an unprecedented amount of money from COVID. Money that municipalities, I don't know if necessarily needed, but of course gladly took. And you could see it with upgrade-downgrade ratios of 4-to-1. You could see it in tax collections that still are reverberating through, but most especially really on how much money is on the balance sheet of state and local governments that came from these one-time payments.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world. Dan Close leads the Municipal Fixed Income Strategic Direction and Investment Perspectives for Nuveen, a $1.2 trillion global asset manager. He is the head of taxable municipals and is the lead portfolio manager for High-Yield Municipal Strategies, along with tax-exempt and taxable municipal strategies. Dan helps set direction for custom fixed income solutions and asset allocation across multi-sector portfolios. He began working in the investment industry in 1998 as an analyst at Bank of America Securities. He joined Nuveen as a municipal fixed income research analyst in 2000, then graduated with a Bachelor of Science in Business from the Miami University and an MBA from the J.L. Kellogg School of Management at Northwestern University. And here is Dan. So Dan, first of all, thank you so much for joining me. I know you have a busy schedule and clear. I can see your desk is clear. You clear your desk just for me. I really appreciate it.
And first of all, Philip, thank you so much for having me on your podcast. It's been great also reviewing some of your other past work as well too. So honored to be on here today.
You know, we have had conversations before. You are a well-known individual in the municipal bond area. So I really appreciate you sharing your knowledge. So there are lots of content to talk about, but let's get started maybe just to get a perspective. And let me just sort of make some intro comments. So based on my knowledge in investing, that the Federal Reserve, the yield curve, that they have some control over the front end. Mm-hmm. The entire curve is sort of the safe investment because it's safe because in theory, it cannot go bankrupt, or at least have never gone bankrupt as United States.
Right.
So everything else get priced against that curve. Mm-hmm. And that curve has been all over the place over the last 2 years. We have experienced significant inflation, almost 10% or what have you, and depending you look at core or CPI or PCE and all those things. And so interest rate went up, tried to control it. And now we have started in September, of course, everybody knows that we are starting the cutting cycle, shall we say. Mm-hmm. And it started with a bang. I did not expect it myself. I don't know about you, but feel free to chime in on that point. But it basically say, okay, 50 basis point. And then Chair Powell goes on stage and say, well, that was just something that we did. And it doesn't say anything about a bad economy. Everything is fantastic.
Right.
That to me is kind of double talk. I mean, it's so fantastic. Why did you do 50? And, and so on, right? So, and because of that, the investing public or the market, of course, always trying to front run or front guess or whatever, or anticipate how fast, how wide, how deep, how long, all those type of things. And I assume that Muni doesn't escape that thinking as well, because it has something to do with what the yield curve is going to look like, especially the portion that the market, which is anything other than the front end, market driven in that sense. So mm-hmm. Maybe Dan, just to first get started, give me some thought about, is Muni in a different universe, or is really in the fixed income universe is not that different on some basic levels? Or is it?
If it's helpful, I thought it'd be good for me to just share something with you, because my Muni yield curve is a bit different than what we have for U.S. Treasuries.
Okay.
The biggest difference that we have between the Muni yield curve and the Treasury curve is really that we're upward sloping. So this is the U.S. Treasury curve, and this is a little bit dated, but you could see, and to your point about it being inverted, about it bumping all over the place. Now, certainly after the Fed funds cut, that this moved down a bit, but just really illustrates, I think, a couple things. One, that this black line is Muni on a tax equivalent basis.
Yeah.
And what you'll note here is that it is pretty much upward sloping. And certainly after the Fed cut of 50 basis points, we really do have some distance between twos and tens now.
Yep.
But it's really remarkable in that as I look at this, the difference between, say, the 20 and 30-year U.S. Treasury, and this is still the case, it's actually a negative slope.
Yeah.
On the muni yield curve, it's just a persistently upward sloping curve. And I think that's really interesting for our marketplace because it's this radical notion that if you go in and lend someone money for a longer period of time, you get paid more. And, we have a curve that does follow treasuries, but it doesn't follow treasuries closely. And I think that's mainly because if you look at the muni market, we haven't grown in 15 years. By that I mean, in the last 15 years, the U.S. muni market has only grown on a cumulative basis 5%. The treasury market is about more than tripled. And so we don't have the supply issues that you see with the treasury market needing to finance a $2 trillion deficit. We have just a relationship that is, I think, a little bit different than treasuries because we just don't have, we have some of the credit issues on the muni side, certainly, that you alluded to that treasuries don't, but we just have a different dynamic in that the supply of munis has not been what we've seen in the treasury market, which has to go in and finance a $2 trillion deficit.
So maybe we can just spend a little bit of time on how that is truly expressed. So I think about the treasury market, of course, it is all that large scale asset lending, creation and all that to first help the GFC, then it helps the COVID. So there's a significant amount of supply.
Right.
And as I understood it, I kind of like the 20-year treasury because it's a little higher than 30-year, which is an anomaly. Sure. And part of it is because of liquidity or not enough people buying the 20 vis-a-vis the 30. So it bumps up a little bit. So one can try to explain the anomalies in the treasury yield curve and how it's inverted because the front end of the yield curve is a shorter dated, where it's more controlled by a single institution, Federal Reserve, whereas the rest is really market driven.
Right.
And so as the Fed starting this cutting cycle, it should start coming back to a complete total positive.
Right.
Whereas in your case, in the muni space, it seems like it's already pretty positive.
Right.
So there's a difference in the curve positioning.
Right.
So sometimes I think about the U.S. Treasuries. There are a lot of non-economic actors buying it. Right. So, central banks of other countries who do trades here and so on. So they are actually long-term holders. They're very long-term holders. And some for political reasons, some for safety reasons, some for just convenience of trading and all the other reasons in between. That must be very different than munis, right? And the holders of munis. I mean, on some level, munis holders are holding it for long-term, I think. And there's a lot less institutional buying. There are more individual holders, so it's a more retail market, right? How does that contribute to this yield curve differential? Does that make sense, my question?
Yeah, it really does because the quick answer for your question as to why is the muni yield curve upward sloping is we've got really more of a term structure in municipals in that we tend to see that the municipal market, give or take, and these are Federal Reserve numbers that come out on a bit of a delayed basis, right around 70% of the municipal market is what we call retail loans. So 50% or so directly mom and pop owning individual bonds and another 20% with mutual funds, ETFs, which is, in my opinion, an extension of retail. Right. So we do have a retail dominated market that has two interests in munis. One, the tax exemption. And, with, I think we'll go a little deeper into the Tax Cut and Jobs Act in a bit and the potential for higher taxes. But, there is a motivation to avoid paying income taxes and state taxes depending on the state. But I think there's also a motivation to go in and to fund local infrastructure. And so what we see a lot of the local buyers they're basically buying their own water and sewer authority, their own school district bonds, just trying to go in and to both get that tax exemption and know that they're also helping at a very local level bring down the cost of financing for projects in their own backyard. And so we do see a term structure where we have a lot of buyers who don't want to take duration risk.
Mm.
And so they're willing to pay up meaningfully to be on the short end of the curve.
Mm.
The intermediate part of the curve generally we see as separately managed accounts, being the primary buyer.
Yeah.
And then the longer end of the curve, 40 Act funds, mutual funds that are the primary buyers. So a lot of our upward sloping nature is just the term structure of the different buyer base, and a lot of retail wanting to go in and not really own paper that's longer than 5 or 6 years.
Mm-hmm.
And so that's been a persistent upward sloping muni yield curve for us. And even with the U.S. Treasury curve meaningfully inverted, especially from 2s to 10s, we've had some inversion, but we haven't had that really meaningful inversion in the muni market. And we've started to go in and get a much more normalized curve as of late.
So even when the front end, we're talking about the Treasury market at 5.25 to 5.5 range before the first cut, it didn't do much against the the municipals, which is kind of interesting. Sure, it's higher, but it seems like municipal didn't have to go much higher. People still appreciated the short end and still appreciated the tax-free nature of municipal. I mean, to me, that was why I would buy munis, because I don't want to pay more taxes if I don't have to pay taxes, I wouldn't do it. Let's put it that way.
Right.
I mean, to be clear, I mean, we pay taxes, we all pay taxes. So that primary motivation is sufficient to have a curve that is more normal than not, which is fascinating.
Right.
And the term premium remains solid. I mean, we expect people, the longer you have my money, the higher the yield I should expect from you.
That's right.
Some of it has to do with time. Some of it has to do with credit issue, right? I mean, if I lend you $100,000 for one day, I feel pretty good. But for 10 years, I should expect more because who knows what happened in 10 years, but hopefully 1 year I'm more, I mean, one day maybe that makes sense. So, and so explaining that vis-a-vis explaining U.S. Treasury, you're talking about totally different factors because it's totally different market drivers. Am I thinking correctly?
Yeah, I think you are. And I think that a lot of it has to do with, as well, just the amount of supply. We have a market that post GFC, the global financial crisis in 2008, you saw municipalities really stop issuing paper for golf courses and for ice hockey rinks and for non-essential, monopolistic, essential service, really infrastructure at the local level, and not any of these far-flung projects. And so as a result, the muni market hasn't really grown more than 0.5% a year in any given year. So that upward sloping nature that we have, I think, is a result of the muni market not growing, the treasury market growing meaningfully, and a lot of that growth being in treasury bills, which then require a higher rate of interest to continue to clear. And our market has also seen a number of wealthy individuals. The U.S. wealth has also nearly doubled since 2008, 2009. So you have a static amount of paper, wealth levels having risen, more and more people being subject to taxes if they could find a legal way to go in and reduce their burden. And so it has created this upwardly sloping nature, especially given that a lot of muni buyers don't want to lend money for longer periods of time. So yes, to your point as well, it is, I think, a fair market in that if you're loaning your local municipality money for a longer period of time, you should accept a higher interest rate, because there are different things that can possibly go wrong that might not go wrong in a day, to your point, but that might go wrong in 10 years, 15, 20 years.
Yeah. So let's turn away from the curve and start thinking about how unique COVID to the pandemic has been, and how the monetary and fiscal responses in saving all of us from a collapsing economy when it was shut down. And the amount of money that was dumped out into the coffers of everywhere, it remains present still. And I always say that there are going to be books and books written about the effect of pandemic and the response thereof, and how so many veterans in our business misunderstood or miscalculated or just missed it altogether. You know the famous Psalm rule. The Psalm rule says that, if labor unemployment goes up by 0.5, then for sure we're going to have recession. And I think that this time is different. And as I say that term, this time is different, I always feel sorry that I probably get it wrong, because almost never different. But this time is different in the sense that the makeup of the labor market is different. And the number of early retirees because of COVID is different. The number of births is different. So you add them together, it's not as predictable as a rule of thumb that would like it to be. There's a vast amount of money. I know my daughter who got $1,800 in her bank account, the largesse of the U.S. government. Municipalities also got money. Talk a little bit about that, and because I want to sort of take a look at that and how I think hopefully you will share with me that the way that we look at the credit rating of a municipality at a certain level is also changed because of that. Right. So let me stop there and let you do the talking.
No, thank you. And I am going to share with you something.
Sure.
Completely correct in that municipalities received an unprecedented amount of money from COVID. And this is just at the state level here at the bottom, Philip, and it looks at state government funds. Total reserve funds for 2023 ended at $428 billion. So this is the blue line here. This is a record amount of money of total reserve funds on the balance sheet of state governments. And it's a very, very similar story as far as magnitude goes for local governments. And so there was 5 rounds of COVID financing. That 5th round of COVID financing, the CARES Act, gave municipalities about $360 billion. It was money that municipalities, I don't know if necessarily needed, but of course gladly took. It's the reason why my home state of Illinois, a big reason, went from Baa3 to A3 as a rainy day fund for the first time in 20 some years. And that money is still on the balance sheet of state and local governments. And I think the response that we've gotten from the federal government for municipalities was extraordinary. Every round of COVID financing included money for municipalities. If you wrap your arms around it, you had airports that in some cases had a decrease of total air traffic of 70, 80, 85% in some cases. But all of these same airports have seen multiple notch upgrades because of COVID money. And you just kind of take a step back and say, there's really no business in America, whether it be a consumer cyclical business, a pharmacy, anything that could go in and have an 80% reduction in its top line and see an upgrade. And so the COVID money that we saw coming into the municipal market, I think was extraordinary. And I think it was, you said your daughter had an $1,800 payment that she eventually spent down. The treatment that municipals got, even relative to the US consumer, was disproportionate. And I think it was this one time, it was actually spread out over 5 payments, but a single period in time where municipalities got just an extraordinary amount of money. And most municipalities, contrary to what a lot of folks did think, didn't go in and create one-time programs or programs that were going to go in and last forever based on this one-time money. Most municipalities paid down pensions, went in and did one-time capital projects, or just salted it away on their balance sheet. And so as a result, we see muni credit as some of the strongest we've seen in more than 40 years because of both an increase in collections and also because they have all of this money on their balance sheet that's unspent. So COVID was very, very good to municipals, and you could see it with upgrade downgrade ratios of 4-to-1 for the last 3 years. You could see it in tax collections that still are reverberating through, but most especially we see it really on how much money is on the balance sheet of state and local governments that came from these one-time payments.
And it sounds like they've been pretty responsible, right? Then, I mean, it didn't like they went and gambled it on the casino floor or something. I mean, they actually did apply into the right places or saved it for a rainy day.
That's right.
Which is that unusual, or did you expect that? Or
I think we had some skepticism. Some credits did go in and create what we think are perpetual programs with short-term money, but that was really few and far between. Most municipalities took this for what it was, which was one-time money, and were very prudent and really used this to save it for a potential recession. So
Yeah.
as we head into a potential slowdown in 2025, the municipals and municipal governments have an unprecedented amount of cash on their balance sheet to really handle a slowdown. So if tax receipts slow, or if the need to go in and to provide social services spikes, there's not going to be really this reaction function that we sometimes see of needing to issue more debt to cover it, or drawing or having any other issues. The money on the balance sheet is there, and we think that really makes muni credit in a very good spot to handle any slowdown or recession.
Terrific. There are a couple other things. So one is, because of the type of thing that we are talking to each other, we are in totally different cities and states,
Right.
that this has brought to almost part of our daily lives,
Mm-hmm.
which was not for sure when COVID first hit.
Mm-hmm.
So this, what I would call collapse of distance, and not a term that I have created, but it's collapsing the distance, right? Collapsing time and distance, has made working from anywhere, anytime possible.
Mm-hmm.
As a result, as you know well, many of the city dwellers have moved out to places where they wouldn't have able to move out to, and there's still, even today, not everybody's back to your normal working at, in an office. That actually created a lot of real estate transactions at the time, at a very low interest rate environment. But property prices had gone up. There was a tremendous demand, especially coastal area, all the nice areas everybody want to go, and they end up buying, and so on. How did does that, or did that help real estate taxes as well for municipality? That was it a negative or a positive or neutral outcome, as far as you can see?
And I will start just again with one more chart to share with you. So we have, through the second quarter numbers just came out, and they're actually even a little bit better. But your four primary sources of collections of taxes in the United States are ad valorem, or property taxes. We'll give it back to that in a second. Personal income taxes, sales taxes, and corporate taxes. And you could see, through the first quarter, and we actually, second quarter numbers are a little bit better. Just had those released here in the last couple days. But you could see we're not where we were in the peak when all the COVID checks were coming out, but certainly well above where we were pre-COVID. And so I think the general trend that we've seen with ad valorem, or local property taxes, which are the primary vehicle for local general obligation bond school districts, we've seen a considerable spike in property taxes for individual dwellings. That has certainly gone up. That's been very durable. That's been great for the coffers of local governments and for state governments as well too. The commercial real estate side for the municipal market, even in San Francisco, Chicago, New York, tends not to be more than a 10 or 15% number. Those numbers on the commercial real estate side, buildings are reevaluated usually every 3 years.
Yeah.
So usually municipalities have a long time to plan for, and to go in and to make plans and change spending patterns, or find alternative revenue sources. So a bit of a bifurcation we expect in the future, where we think local property taxes for residential should continue to do well. We're expecting some sort of revamp once these 3-year assessments really take hold in large cities.
Yeah.
But what we do find on most local governments is that they're very resilient and can go in and pivot to personal income taxes, corporate taxes, go in and pivot to other ways to go in and to collect revenue. And so I think with the lower rates and the COVID boom in real estate, it has been by far on balance very, very positive for local school districts and local general obligation bonds. But we do anticipate going forward, we're going to have some uneven performance with residential continuing to do relatively well, but on the commercial real estate side, some deterioration.
So there are different type of commercial, as you pointed out, I mean, there's the office commercial, which is probably one of the most challenged. Maybe some retail commercial is a retail space, maybe
Hmm.
shopping malls and stuff like that may be challenged. But then there's this whole world of data center and all the
Hmm.
other stuff. So I'm going to say something you're probably going to appreciate. I hope you will. Is the active management in this case
Sure.
matters? Just
Absolutely.
don't go buy a index of all municipal bonds. You're going to get the good and the bad, and nobody's picking them. So is that a direction that you think that you can try to find some to avoid, where there's a significant amount of office space, where they have more dependent on certain number of large cities, vis-a-vis municipalities, that you can participate in some of the newer things, just in time delivery, warehousing and all that type of stuff.
Yeah, for municipal credit, I think what's really fascinating is there's more than 50,000 different issuers. Uh, any investment process that you have in the municipal market has to be really driven by bottom-up credit fundamentals. So whether it's a local GO or a water and sewer authority or a hospital, a nonprofit hospital, yeah, everything is really driven by that bottom-up credit selection. And so, we've seen ETFs really proliferate meaningfully on the equity side going back more than a decade. Corporate side, it's, probably 5, 6, 7 years ago where it really had that hockey stick
Yeah.
type growth. We haven't seen that as much on the municipal side, partly because it's just tough with 50,000 different issuers. You're basically doing sampling to replicate the index.
Yeah.
And so I think for the active management side to your question, yeah, I think that with a analyst group on our team at fluctuating from 22 to 25 analysts, we have the ability to go and look at each individual credit on a bottom-up basis. So I think the fascinating part about munis, you might have in cities neighboring each other, similar demographics, similar wealth levels, but one city, for whatever reason, just is mismanaged, going in and overspending, going in and taking on projects it ought not. And their credit ratings could be materially different from each other as you look at them. So when we're going in and looking at any credit, our analysts are assigning their own credit rating. And it's important because I think that fundamental bottom-up analysis really does help. And that active management does go in and we think avoids a lot of credit pitfalls that could come if you're just going in and buying a passive fund.
I'm going to just quickly touch on a couple other things, because ultimately I want to talk a little bit about high yield, which is one of your specialties, and how this is not your father's high yield anymore. So let me just talk a couple more things. One is about immigration and migration.
Hmm.
I just looked at some numbers, and I'm writing my quarterly commentary. And one of the things that I'm doing a little bit more research is on the American workforce, and how we have all undercounted the migration since 2019 forward till now, and going forward. The actual number of um, domestic workers
Hmm.
have left workplace, either due to retirement or due to a whole bunch of reasons. And so the GAO report came out very recently that shows that at the end, this immigration or migration, this immigration, it's a very positive thing.
Hmm.
Well, the federal budget, we didn't talk about the state budget, state or municipality. If they did that particular article, the GAO, you can find it online. A GAO did talk about that for the state and in municipalities, the impact is a little different, because if you bring a lot of children having years, right, though they need more schools and they need hospitals, they need all those type of things.
Hmm.
Um, what is your thinking about certain municipalities or certain states where immigration is a bigger issue?
Hmm.
How does that impact your credit rating or thinking about them? Certainly not only in the short run, but in the sort of intermediate space. Does it impact your thinking at all?
I mean, it does, to the extent that the supposition is correct that it is costly to have, migrants coming in. We've primarily seen on the muni side 3 cities that have had a disproportionate impact, and that's been Denver and Chicago and New York.
Yeah.
All 3 of those cities, have the reserve funds. I think in the short term, We don't think it's going to be too big of a credit impact in the short term, provided there is some solution at the federal level or at least the state level, sharing in some of that support.
Yeah.
So I think right now, if you were to ask any of our analysts, AAA Denver, might have an issue if this is still persistent in a couple of years, as does New York, that has to go in and find housing and
Right.
different shelter for these migrants.
Yeah.
So I think longer term it could have a credit impact, but I think right now we don't think that has a meaningful impact, and don't think it will have an impact on the credit rating of these specific names and these cities if it's something that's resolved in fairly short order.
It's case by case, some of it, and some
For
of it
sure.
you're just not seeing that kind of an impact per se that will cause the credit to drop significantly in any meaningful way. Let's put it that way.
No, and usually, Philip, when we have any downgrades, it's not like on the corporate side where an LBO or
Yeah.
something could go in and drop something 6 or 7 notches. It's a very gradual process. So you might see watches for some of the cities that have had a disproportionate impact, but we think the credit impact at least for the very near term is limited.
It would be interesting if you and I start doing LBO of a municipality. I think that would be just a thought. I know it. Anyways, the couple more other really kind of things that are on my mind is really talking about the energy transition.
Sure.
And how utilities in different states. I mean, the 3 Mile Island one is coming back online, I think, for
Microsoft, right?
just to get enough power. That will link to the Inflation Reduction Act and other huge legislation that passed with huge amount of money commitment. And part of that is going to go to the state and local and the municipality level. Is this another largesse that's beyond what we talked about from COVID, the 5 times that they help to sort of give a buffer? Is this additional? And if it is, how do we invest in that? And how do you think about investing in that type of projects from a municipal bond standpoint?
Yeah, I think as it pertains to our market, one of the biggest items in the Inflation Reduction Act was setting a base charge or fee for nuclear plants. And so if you have a nuclear fleet, for instance, you have a base charge that you're going to get. So if it does fall below that, you basically get reimbursed from provisions in this act. And I think that's been helpful. I mean, in the municipal side, we saw 2 nuclear reactors come up in Southeast Georgia, that first reactors that have come on in decades. And so we do think that this is going to, given you have a minimum amount base for nuclear generation, we think this does go in and encourage more development as we go along. We do think it is going to encourage further development of transmission lines. And I think you touched on it in your remarks that there is this need for energy that we have not had in a very long time,
Right.
given AI, given the need for data warehousing. And if entities want to go in and really invest in infrastructure, they usually come to the municipal market. So there are so many credits in the municipal market that are called joint powers, where it's 15, 100 different municipalities that come together, share resources to go in and to buy their own generation, buy their own transmission lines, and go out and issue municipal debt for it. So we do think that, as with any infrastructure in the United States, it is going to come through the municipal market, and there's a good amount of our electric utility providers that are not for profit, that are actually municipal governments that will come in and need to issue debt or use the Inflation Reduction Act to go in and to build out more infrastructure.
So with that, is that a better bet because you have basically a federal and non-federal partnership, right? They come up with some money, and then is that a better credit? Is that a better deal? Is that something people look to, or not really? Or is still case by case?
Yeah, it's still really case by case. We do believe that each credit is going to be based on its own merit. It's certainly helpful that the federal government is coming in.
Right?
Anytime we have the Inflation Reduction Act or the infrastructure bill that was signed, gosh, going back 2 years or so,
Yeah.
anytime that there is a partnership between the federal and state and local governments, we think it's certainly a good thing, but it is really case by case.
And then you remember not long ago in Baltimore, one of the bridges got destroyed.
Right, the key bridge, right?
So there's the Infrastructure and Jobs Act as well. How much of that is federal government as well, municipality, and how? In other words, there just seems like there's so much money supporting both state and federal level. I mean, state and local level
Right.
on something or another. It should be very vibrant, a market for municipalities. What I'm just thinking out loud. I don't know
Right.
if that's true. Is that a bad assumption? Is that a bad conclusion? Or what's your thought about all that?
No, and we have seen this. I mean, in our market, and sorry, I'm not going to try to overshare on slides too much, but the one thing that we've really witnessed is this big pickup in issuance. And issuance has gone up considerably, mainly because we've seen a lot of infrastructure that was supposed to happen in 2021 and 2022. More in 2022 and 2023 was delayed because of the cost of steel and concrete and construction workers. And so we note here through August, issuance is up 37% year to date versus the same period last year.
Yeah.
And that's primarily for two reasons. One is you have had a lot of municipalities who now see the cost of construction has gone down, which is great, and they're now bringing debt to issue it. We have a number of airports doing major construction projects right now,
Right.
and part of that issuance is just trying to avoid the election. But I think the market really does remain vibrant for these large infrastructure projects. We just witnessed JFK come in and bring multi-billion-dollar deals for the modernization of some of their terminals. So we're starting to see it come through with more issuance, and we anticipate that this does continue as a lot of projects that would have happened in 22 or 23 were put on hold due to cost.
Terrific. So let's spend just the last few moments on high yield.
Certainly.
This is my personal opinion that I think that this is not the high yield that you thought it was the high yield because of so many of the things we talked about. And you may have many other, I'm sure you have other reasons. Who isn't looking for high yield? What we don't want is the credit risk that comes with high yield.
Right.
But if we have so many billions and billions of dollars pouring into this, in theory, not so credible issuers, it seems like their credibility have improved. So can you talk a little bit about that opportunity set and how we should think about the high yield municipal universe vis-a-vis the non-high yield, and how they are probably closer or not, and how should one think about that? And should we always be afraid of high yield? Should we not be afraid of high yield? And can you share a little bit about that? I mean, I think that would be really helpful.
Certainly. And I'll share my screen one more time here.
Great.
I think the interesting thing with high yield right now is that if you look at, and this is just taking what the yield index is, the high yield index at the 529, you make this a taxable equivalent yield by assuming someone's in the 37% tax bracket and is paying this 3.8% Medicare surcharge.
Yes.
And you start looking at this number and you say, gosh, 8.5%, 9% on a taxable equivalent yield. This is starting to look like long-term equity returns. And this just comes from clipping your coupon.
Yeah.
And so as I think about high yield, you still have this in municipals, it's still an essential service monopoly. So it's a healthcare provider that is in a rural place. It's a community development district that is just beginning putting in streetscaping and potable water and traffic lights, and is going to build up and improve over time. These are still essential service monopoly providers. They're just in a startup phase. So as I think about high yield, it still has all the characteristics of municipals, which is, again, infrastructure, essential service monopoly. A lot of times you're getting mortgages on facilities. But showing that number we just showed, that 8.5 to 9% equivalent yield, you're starting right now, given how much rates have backed up, you're starting to approach a point in time where these are starting to look like longer term equity returns. So, certainly you can have rates back up and that could change that picture, but just from income, that's the way I'm really thinking about higher, high yield. And I think that it gets back to our discussion that this is mainly a case by case analysis of all these different types of credits.
But it sounds like it's a time, based on our initial portion of our discussion, that with the amount of investment from the federal government, either free money or however you want to call it,
Mm-hmm.
does it change the way you think about the credit in this case? I mean, some of it will be obvious because the affordability becomes higher,
Right.
the ability to perform, and the chance of a default is reduced, not in every case, but in cases that otherwise wouldn't be.
Mm-hmm.
So this sounds like a wonderful time to take advantage of that term, high yield.
Right. Right.
Am I thinking correctly? I'm not telling everybody to do this. This is not my point. I'm just trying to figure out from a risk equivalent basis,
Mm-hmm.
right? This high yield is not your old high yield anymore if you pick the right high yield.
Yeah, that's correct. I mean, we see, especially when you compare this type of high yield to corporate high yield, they're materially different as far as default rates go. The municipal default rate considerably lower. Yeah, and it's certainly a point with this COVID money. Certainly has had a meaningful impact on all aspects of of municipal credit, both very high grade and also high yield. And so we have seen that come through. We've seen credit improvement everywhere on the municipal spectrum. In some cases, you do need to be careful because I think COVID money did cover up a lot of issues and problems in some smaller higher education credits where that money is now rolling off and we're starting to see more covenants trip, more defaults happening. But I think for a lot of your municipal credits, the transfer payments we've seen from the federal government over the last 4 years or so have really helped out the overall credit profile of both high grade and high yield.
One last question on high yield.
Sure thing.
What could go wrong? This sounds like really nice because if you look at, I know Nuveen, you all own Churchill, which is in the mid-market lending, which is, in my mind, high yield. And that their rates are not significantly better after taxes, right, than somebody like a municipality. And the size you cannot even compare when you talk about municipality with the mid-market. So are we talking about if the Fed continue to cut rates, which I think they will, but I don't think it's as aggressively as the market believe it would. So let's say it ends in the four handle, right? Let's say upper three, 375, 415 area. Do you expect the muni to drop in synchrony with that? Because when we first started out, you show us that graph that was wonderful, really interesting, positive yielding. It's really seems like it's two different worlds, literally, right? Do you see that getting more closely with each other, where the spread become more closely tied, or you still feel that there's a disparity, there's a bigger delta that you can exploit? What's your thought on that from a high yield perspective?
Yeah, and I think, you brought up what can go wrong. We have a high yield fund that's got a 12-year duration. So if rates do back up, you do have a duration profile that's reasonably long. And so when I say rates back up, rates go up. It will affect any fund that has any amount of duration. And so our high yield suite does have longer duration vehicles. We could be completely wrong on credit, and credit could go in, and certainly spreads could widen if a coming economic period we have a recession, and that recession is particularly deep. So as far as what could go wrong, it's certainly it's rates driven and it's credit driven. And if you have spreads widening at the same time yields are going up, you could have a negative outcome on your high yield investment. But certainly I think with your question on the convergence of the curves, We think the muni yield curve is going to normalize a lot quicker than that of treasuries. And that's just because of the term premium that we had been discussing of investors demanding higher rates of interest for longer lending periods. And so, I think I could comment on my curve. I think it's a lot tougher to comment on the hows and the whats of the U.S. Treasury curve. But I think we get to a more normal curve a lot faster than we get on the Treasury side. And your risks on the high yield market are what they've always been, which is duration and credit.
Well, Dan, thank you so much. I know I could just go on and on because there are obviously other questions I could ask you, and you have been just so patient in answering every question I have asked. So thank you for your time. And really, I learn something every time I speak with you. So this is very helpful. And hope that we can speak again on and off camera.
Likewise. And thank you so much for having me on your podcast today. I really do appreciate your time.
You can always find more episodes by visiting philipchao.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchao.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.